Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending May 20th, 2016. I've got on the screen here the S&P 500 E-mini futures. Before I jump into it, it's a daily chart by the way, but before I jump into it, I want everybody to understand that stimulus does have consequences. I was thumbing through a lot of articles as well as listening to some of the talking heads on some of the business channels on TV, and it's really amazing. I could see where a lot of individual traders and investors get very confused because you've got some that are saying the market's going to go up and make new highs. You've got others that are saying the markets are going to fall. Some saying guaranteed fall. So it's really amazing, and everybody's out there trying to predict where the market's going to go, and they're racking their brains. They're just racking their brains on just saying, hey, let me show you where I believe the market's going to go because of the following logical cause and effect patterns that we're seeing. Well, here at Trader User Group, we don't really try and guess where the market is going to go. We like to follow trends, but we follow the trends. We use price action to dictate the higher probabilistic move where we have an edge. And remember, if you're trading for the next 10, 20, 30 years, you're going to be doing thousands of trades. And you're looking for that expectation, that positive expectancy that says you've got an edge in the market that's going to grow your equity curve. That's what you want to try and do. Yes, you can guess. And you can put some money out there and expose it to risk. And you can guess and you may be right. But I would probably almost assure you, just like the odds in Vegas or the way the insurance business works, you do that 1,000 times and you're going to lose as many, if not more, than you win. And then you're going to net zero or even down. So you don't want to focus on trying to guess. You really want to use the charts, the price pattern, the action, the volume, and some of the indicators the way we have them set up on our charts to really give you a higher probabilistic move. Now, I said stimulus has its consequences. We're seeing right now globally bank stocks just getting killed. I'd like to see banks performing much better. That's a consequence of all this stimulus, especially as we moved into negative interest rates, which kind of started in Northern Europe and then has moved down into the ECB and then across the pond, the Pacific, over to Japan. But we've seen Eurozone bank stocks have fallen down to about their 2008 crisis levels. We've seen Japanese stocks bank stocks off about 30%, and I've seen Chinese bank stocks off about 40%. That's nowhere to be showing health in a global economy. And just this past week, we had the Feds come out and have a more hawkish tone, and naturally the market sold off a little bit. If you recall, I said one of really the only thing that determines share price, stock price, and where it goes is corporate earnings, and earnings for that particular asset and interest rates. And you put those two together and it derives a value of a fair value for that stock. So for us, again, we don't care. We will follow the price action. And many times it may not seem logical, but it's really not us to determine and argue with the markets. If price wants to go up, that's where we go. If it wants to go down, that's where we go. But the Feds are in a box right now. They've kind of voiced to the market that they said the June meeting is a quote-unquote live meeting, meaning they were going to discuss raising the rates. Didn't say they would. The markets had forecast prior to last week about a 4 or a 5% shot at the Feds raising their rates in June, 25 basis points. The 30-day Fed Fund futures is a good proxy for the short-term bet of the Feds. And it called it at about 4%, I think. After last week, it jumped up to 30%. Really amazing. But we haven't seen the markets fall in a defined bearish mode. That would be 20%. It's like the second longest bull run we've seen. So it's really going to be interesting to see, because we've got the long end of the yield curve. That would be the 30-year bond. The interest rates are down very low. We've got the short end of the yield curve, interest rates up fairly high, which is called a flattening of the difference between the two. It's called a yield curve. And the flatter that gets, it just shows no prospects for growth in the market, or at least that's what the markets are anticipating. And if that yield curve goes negative, which it did in 08 and 09, it shows that we're in a recession. And typically by the time it shows that you've been in a recession, you just don't know it. You may know it personally, but the market price action hadn't shown it. So that's what we're seeing right now. So for us, we just want to follow the price action. Now, I want to put you just focus on the screen right now. I've got the daily chart of the S&P 500 futures. I'll blow it up a little bit. And we're right on that edge here of a key price action break, and we haven't seen it yet. But if I were to kind of just draw a line like that, that's called the neckline. And you can see here it is the formation of a head and shoulders pattern. Left shoulder, head right here, and then right shoulder right here. And then typically when you measure the break, you measure the top of the head to the neckline, you calculate that distance, and then you extend it over here like this. And when you do that, you will find it takes us right down to about that 50% fib node, which I measured from the lows on February the 11th to this high here that we made in April 20th. Now, just to show you here, and you can do it a number of different ways, and this will be, I'm just going to do it real quick here. So I'm just going to click on this link right here and then just kind of throw a measurement out here like this, just kind of take it down. And then I can come over here and move it here off the neckline like that. And you can see here that it takes it down. Let me just move it over just a little bit right here. If we have a break in this right in that area there, you can see it takes us right down to about 1954, 1951. I don't have the exact numbers here. I haven't done the calculation. This is just done real quick for you guys. But you can see here that in this move, it's showing about a 3.8, call it right at about a 4% down move, which is not much, and that would be a 4% down move from the break of the neckline. And again, it puts us at the 50% fib node right there, okay? Now, I've seen when, and again, a head and shoulders pattern trigger is when the neckline breaks. So price action falls below, it closes below on the time frame you're looking at, in this case a daily chart, and then I have seen better than 50% of the time, so that means it's a probabilistic edge that the markets will move back up and do another retest of that neckline. And on that second retest there, that is going to be a key tell. If the price action moves above the neckline and it stays, and then the neckline becomes support and moves higher, then you can just, you know, say, okay, the pattern failed and we're moving higher. All right, but if the price breaks that neckline, comes up and does a retest, and it fails, it comes down and takes out that prior pivot low from that initial break, then we're going down. All right, and that's what I'm going to be looking at. We came very close. You can see that initial price action right there where we moved down below the neckline, but we actually closed back up above the neckline before the end of the day. So that was not an official break. Remember, on the daily chart, you want to see where the price action ends at the end of the day. That's what we're concerned about. So if we look at this, let me just clean up the screen here for a bit. You can see the pattern and just how close we are to this thing. And if I step it out just a little bit, you can see these fib nodes right here. And as you saw before, we've got the Elliott wave 3-leg, a 4-leg we're looking to do, and then a 5-leg up in this area here. And then that 5-leg, after we hit a 5-leg, we get an ABC chop pattern like this. And then it says, do we want to go this way, or do we want to go this way, or do we just want to chop? You know, so we've got to, obviously this is the side of the chart we trade, this is the side of the chart we use in our analysis to determine which way we want to go. Keep in mind, price action reflects all earnings, all fundamentals, all geopolitical events, all fear and greed of all the traders out there. So it's not necessary that you follow earnings to the T and really understand that. Having a good understanding of the intermarket relationships between debt and equity and commodities is very, very important, because it'll help you get a bead on a trigger and a break. But for now, as you continue your your progress and your learning. This is generally what we do, and it works out very well. Long term, we have the edge, and it works out. Not trying to guess where the market is going to be, but we follow the market. Now, let me just clean this up for you a bit. You can see here on this daily chart, we're just slightly above the 50 EMA. The 200 EMA actually held up for us, but it's just this nagging downward action here like that. Okay, and if I were to kind of just draw it down, that's what it looks like. Now, if I were to, let me get that off the screen here for just 1 second, and let's just crunch it down like this just to give you a better idea. You can see here this pattern is actually a bullish pattern. It's a profit-taking pattern right now. So, and if we look at it, you can see by drawing it down here like that, you can say that as the markets move up, you got this bullish, you got this wedge forming where traditionally it breaks to the upside, and which is why we have that 3, 4, and then a 5 pattern like this, okay? Because it breaks in the direction of how you entered that pattern. We entered the pattern to the upside. That would be the traditional break to the upside. Gives us the 3, 4, 5. Now, that doesn't mean that's what's going to happen, guys. We can come right back up to the top of this channel and then come down and form another low at the bottom of this channel and continue this business like this all the way down. Maybe stopping at the 38% fib node, the 50% fib node, who knows? Right now, though, we've been neutral to slightly bearish in the market since we've been making lower highs and lower lows, because that's the other definition, obviously, of a trend is higher highs, higher lows, or lower lows, lower highs. And you can see here very clearly that we've been, you know, from that April 20th, you know, we've just worked our way down like this, okay? So we need to break that pattern to be able to break out of this 4-leg down like that and come back up like that. Will it happen? Well, typically a way to do this and a way to measure this, for those of you out there that are just, you know, interested in something like that, I can come on here and I can put my regression line right on here like that, and you can see the regression line when it tries to force fit both up and down. We're sitting right in the center here, okay? And the let me just widen it out so you guys can see a little bit better. You can see all of this volume right here that comes out off the side of the chart here. That volume is there's a big fight going on right now with the bulls and the bears. You can see as you go higher, that volume at that price level drops off dramatically. And this goes all the way back to the beginning of the year, right, the volume. So you can see the volume actually peaks right in this area here, and we're kind of right in that area. So we've got this big fight going on with the bulls and the bears right now. But should we break this upper trend line and then we take that out, which is the prior pivot high, then the odds do favor us coming up here and making a new pivot high up here like this. Do I think it's going to happen? I think we've got a lot of overhead resistance here like this that's really providing downward pressure. The markets appear like they want to run, right? They appear like they want to run, but we're clearly in a down mode right now. Clearly. I've been having our members take on more puts back in this area here around the 3rd week in April. We had lower vol, and I was highly encouraged our members to take on the puts, right? That's kind of what I wanted to see here. So this is kind of where we are with the E-mini S&P 500 futures. If we look at the Dow transports, keep in mind with the Dow transports, it's a completely different pattern. Remember, the Dow transports led the markets lower in August of last year, 2015. The Dow transports started going down in 2015 in February, and they kept going down. They gave us a good 4 or 5 month advance notice of the rest of the markets before the markets just came unglued in August of 2015. You can see here the transports are going down as well. The pattern is different though. On this pattern here, you can see with these transports, we made a higher high right here from right here, but we set up a really good divergence. And then we took out a prior pivot low right there. That was a key move right there. And taking out that pivot low really means that right now we're on a sell or rally on a daily basis with the transports. What I'm watching for the transports is the opening price of 2016. You can see way back over here where we gapped down and we opened there in 2016, and the markets just started moving down. And the transports made its low on the 18th or 19th of January, right? Early January. The equities made their low almost 1 month later, okay? And then the transport started moving higher. And then by the time February the 11th came around, it was right around here. The transports had already started their run up. So it gave us a good 3-week, 4-week notice. So what we want to do is use that 3 or 4 week notice, this time to the downside. If this rally fails here around the 50 or 200 EMA and starts rolling back over, takes out the 2016 open price, start adding more puts to your longs if you are long. If you're short, that's a good thing. Okay, so that's kind of what I'm seeing in the transports and why we're following it. Now, I talked about yields, and if we look at the bond market, that first day was a shock to the bond market when the Feds came out and were more hawkish. Bonds fell over 2 points. But if you look at this bond market, I mean, we've really been in this pattern like this for quite some time. Okay, I mean, that's where we've been. We poked our head up above intraday here, only 1 day here to see us come right back inside this box again. So anywhere up here, I think you're going to see a lot of shorts only too happy, a lot of investors only too happy to just short the crap out of bond futures. But we're kind of right in the center of this box here. And it's that way, I believe, the markets have kind of positioned themselves to say, you know, what are the Feds going to do? And that's where we're going to see bond action right now. But even an upward move in the bond action, I'm going to be more willing to be up here saying, you know what, I'm just going to short the bond market because I just don't see, unless we have our bear market and the markets pull back 20%, we will come up and challenge that 170 area. That was right on my target way back when, and we just went up there and we hit it perfectly. Right now, we're going to have a lot, excuse me, chop to the upside and to the downside in the bond market. Now, if we look at the interest rates, and let's look at the 10-year interest rates first. You can see here like this, clearly on these 10-year interest rates, we've had the market's doing one of these kind of things. But we've got a fairly good support base like this, right? We poked our head below, but it's only lasted a day. So we're in this wind up here like this. Now, this pattern, because we entered it from that direction, would suggest a break to the downside. But it's just, we're getting some of these divergences here that would also suggest a break to the upside. So there is confusion in the interest rates. The 10-year rate right now is very low. It's like at 1.849. Right? Now, the reason why the markets this year, correlation between equities and bonds is a little bit strange is because we got a lot of money. Remember I talked about negative interest rates in Europe and the ECB and Japan? A lot of that money is coming from Europe and Japan into the 10-year and 30-year, and that keeps our interest rates down. We don't have as many American investors coming in here, but we certainly have a lot of Japanese and European investors because their same yield on their 10-year is down around 4 basis points, 40 basis points to like maybe 80 basis points. So they can double or add 120% to their yield just by investing in U.S. Treasuries. So all that money comes over here. But all this is doing, guys, is creating a humongous bubble. When Europe starts to clear up and the fog starts to clear, and Japan, you're going to see the money that has gone into these instruments just be sucked back over to other countries. And you're going to see these rates go up dramatically. I mean, they're just going to go up dramatically. So that's what we're going to be watching our group. It's going to be a great trade when it happens. Not ready yet. Currencies are another thing. We had the dollar actually, you know, found a support point and is holding here. And there's a lot of debate on where the dollar is going to go. And if I kind of move it out like, well, let me just shrink it down just a little bit just to kind of give you an idea of just what it's done here. You can see the dollar once the Fed started, once the Fed started ending their taper, and they started talking about moving the rates or taking money out of the U.S. markets, the dollar just went on a tear. And when the dollar did this, all commodities crashed, including oil, and it helped precipitate the downward move. And then we've got this huge support point sitting right here at the 0.38 fib node, and we've hit it several times and we bounced. We're now sitting at a 236 node right here. So we're at a moment of truth, as I showed you, in the bond market and in the dollar market. Which way are we going to go? And again, I'm not a betting man. I like to do calculated bets where I put the edge in my corner, all right? And should we get some continued break to the upside, then we're going to see the dollar go higher, the euro go lower. If the euro gets much stronger, you're going to see the ECB come out and try and talk it down. We did that same thing with the yen. You can see the yen made 2016 highs right here back on May 3rd, and I said the bet here is doing bear call spreads in yen currencies, shorting the yen right in this area here, or just going into FXY and trading that to the downside. I mean, that was a high probability trade, and as you can see, it worked out nicely for those that took the trade. Gold, well, you can see on this daily chart with gold right here, we did have our 3, 4, 5 pattern, right? It fired off, and we had the typical Elliott wave pattern go down and come up like that. It gave us the, on a 5 leg, you should always see a divergence in the MACD. That's what we got. We got that sell-off, but you can see how it's holding the 50 EMA very nicely. Should that break, we could get a further slide down very quickly down to around the 1200 level. The gold market is a very technical trading instrument. It tends to go, where the technical support elements are on the chart. And the next one down is 1200. Should we break the 50 EMA? The 50 EMA is sitting at about 1249. We're at 1252. So we're close to that break. But, since 2016, we've just been moving straight up. And now we're just consolidating these gains. And then if we look at oil, I've seen oil in a number of instances, a lot of people trying to forecast where's oil going to go, okay? And I look at this and I say that the near term to me is more sideways to slightly down. I do not see a lot of near term upside movement in oil where you just explode to the upside like we've had over in this area here, and these explosions up like that. That is not really what I would call a 3, 4, 5 pattern. I would probably, if I was doing the count, I would probably make that a larger 3 leg here, giving us a longer pullback here down to the low 40s before we try and make another attempt up like that. But we're right at 2016 highs in oil right now, okay? And in fact, we've got some trades on in our secret trader for our members in the oil market. And so that's, and then the other one that we've been following very closely is in the agricultural market is the soybeans. We've done a number of trades, probably 4 separate trades in the soybean market. Every one's been a winner. We put the odds in our favor when we do the trade. You can see what soybeans have done. You can see the movement off the lows down here in early March, and it's just exploded to the upside. If we look at corn, looking for a similar move, we don't quite have it. Corn has moved up, but it's well off its highs, and it's very jagged the way corn has moved. And if you look at wheat, you're going to see with wheat, it's even worse. In fact, with wheat, we are below our 2016 open price. We're sitting here, 2016, it's open higher. So generally the ag market moves in concert with each other. You don't get too much. Generally, if you're seeing stronger wheat, you'll see stronger corn and soybeans. You'll see some lead over the others, but that shifts in time. But the ag market tends to follow in concert because we've got the wheat below the 2016 open price, and we've got corn sitting here at near the 2016 highs, and then we have soybeans right at the 2016 highs. To me, just looking at this, if we had a trigger, I would see that there's going to be less downside action in wheat than, say, corn or soybeans. If we trigger down, yeah, wheat will fall, but I don't think it's going to fall like the other two. They're overextended to the upside. So, getting some puts underneath the 2016 lows in wheat, to me, makes sense on that trade. One other final thing we'll take a look at, and I'll call it quits for this weekly update, is volatility. If we look at the VIX, it closed down on Friday, but we are still in a zone 2 environment. You can see how I have my zone set up here, and I do this for a lot of our members. Generally, when you go from zone 1, 2, 3, 4, and then 5, which is the black swan way up in that area there, you start to look at your option strategies a little bit different. Whether you're bullish or bearish, you use option strategies that play well across each of these zones. Certain option strategies that do very well in zone 1 are the worst ones to do in zone 2 and clearly zone 3. So we're watching this, and you can see right here that we're right on the border between zone 1 and zone 2. It's very difficult to predict where volatility is going to go next. We go look at the futures market. We look to see if we're in a contango environment, which we are. That's a normal term structure for futures. When volatility starts to get out of whack, we go into backwardation. But we're in a contango right now, so that's going to suggest this week could be a relatively calm week. Just as a reminder, this is going to be this coming week will be a normal trading week after option expiration this past week. But we're going to see a long weekend with Memorial Day weekend here in the United States. So Monday will be a holiday. So it'll be a long 4-day weekend. We've got Janet Yellen actually doing a speak, or she's going to be speaking on Friday. So what a way to end the week with Yellen speaking, because she can move those markets a lot more than any other Fed governor can. Hopefully she won't mention anything about the markets, and we can end on a quiet note going into the long Memorial Day weekend. It's official summer kickoff. All right, everybody, for our members, I will see you this Sunday night. If you're not a member, I highly encourage you to come in and check us out. We're doing well, and we got a lot of really cool trades coming up. We put some on recently, and I think these are going to work out nicely over time as well. All right, everybody, have a great weekend, and I'll see our members Sunday night. Ciao, everybody.